Welcome to ODEON Capital Conversations on all things money and markets with Dick Bove and Matt Van ALSTYNE. And here is your host, John Aidan Byrne.
On this episode, Dick Bove will describe the full scale of the huge bank loan losses he expects will soon hit the bank's highly leveraged loan sector of companies in the private equity space, struggling with cash flow and debt as higher interest rates take a huge toll. Dick is out with a new report. He says the loan losses could run into the multiple billions of dollars. Inflation is easing, but the Fed may not be done yet in its campaign to keep a lid on price rises. What could derail the Fed's progress? We'll have more on that. America has a record of over 22 million millionaires, but we'll ask, what does it take to be really rich in America today? Matt Van ALSTYNE has more on the dysfunction in Congress as the nation's finances and levels of borrowing remain in dire condition. We'll discuss the wars in Ukraine and Israel, and we'll take a look at some events out of China. I'm with Dick Bove, Chief Financial Strategist at ODEON Capital Group, and Matt Van ALSTYNE, ODEON Co-founder and Managing Partner. And we'll be right back after this message.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.
Dick and Matt, welcome for episode 97. We should have more clarity this week, right, on where inflation is finally headed. We have the PCE index report coming out on Thursday. There's a sort of a widespread assumption, or at least a lot of analysts feel, that interest rate rises are off the table. We may see the first rate cut as early as May. So is inflation defeated, Dick? Are interest rates, the Fed, going to pause on that? Where do you see that? Because you've a report out on the Fed's balance sheet. You say, and you've mentioned this numerous times, there's a tight monetary policy at play. And until this policy changes, it is premature to argue that the Fed has peaked or that interest rates are about to decline sharply in 2024. So tighter monetary conditions equate to higher interest rates, at least the long rates?
Yeah, no, I think that that most people are exactly correct, that this short rate cycle is peaked, that basically the Fed has no real interest in increasing short rates at the present time, and probably, if they're going to do one more or not, but I doubt that they are. But even if they do, I think that, it's peaked. They're not going to be pushing short rates higher, for a meaningful period of time. However, that does not indicate, in my mind, that they have walked away from the fight on inflation, or that you're going to see a sizable number of, cuts in short interest rates in, 2024. And the reason that I say that is because, as I've indicated many times, I look at money, I look at the Fed, which creates money, and I believe that if the Fed, cuts the size of its balance sheet, it's obviously cutting the size of the money supply, and therefore they're maintaining tight monetary policy. So even though, people want to focus on this one element, short-term interest rates, I think they've got to broaden their point of view to understand what the Fed is doing, and they've got to take a look at it. Is the Fed continuing to shrink its balance sheet? And it is. There's no indication whatsoever that the Fed has made the decision to stop shrinking the balance sheet and to expand it. So my guess is that the Fed is saying, okay, we've done a lot. Inflation is down, and I think we're not going back to high levels of inflation anytime soon. Inflation is down, and now we have to simply hold tight and make sure that it doesn't come back. And the way we're going to hold tight is by keeping the money supply in check. We're not going to let the money supply go up. And I think, therefore, we're in a period now where it's up to the economy to do what the economy is going to do. And it's not going to be the Fed that's going to be driving it one way or the other.
Is there anything that could derail this good news story on inflation? Oil, maybe. I mean, I'm listening to some reports out there that OPEC is discussing oil production cuts, government spending. Could anything reverse the course of inflation?
Yeah, yes. I mean, we've done a lot of work now on households, right? And how much money they have. And I know that it sounds ridiculous, but if you just divide the increase in the number of households the increase in the number of households who are millionaires by the number of days in the year, you're adding 1,900 millionaires every day. Every day, 1,900 millionaires. 1 out of every 15 people in the United States are millionaires. It's 221 million of them. So the net effect is, if they're going to continue to go out and spend money at a relatively rapid clip. I mean, everybody gets all excited over Black Friday, but if they're going to do that, it's going to turn the inflation numbers around and push them back up, because what we've seen in the third quarter numbers coming out of the S&P 500 is that, everybody thinks it was a great quarter because they beat the estimates, not because they beat what they did last year. But when you go into why they beat the estimates, it's not because they sold a lot more products. It's because they increased prices. So the net effect is they can continue to increase prices if all of these many millionaires go out and spend money. But if they don't go out and spend money, then basically those price increases are going to be cut. The margins are going to come down for these companies, and we're not going to have a very robust, if you will, 2024 in terms of corporate earnings. So yes, what would turn it around is, you've got a staggering amount of money in American households. We're the richest people in the world. No country has ever seen wealth of this nature spread this widely over the population. And therefore, if this continues, and these people spend this money, remember, $80 trillion in household wealth created in 3 years. It took 230 years to create the first 66 trillion. So the money is there. If it gets spent all at once, inflation comes back.
Before you come in here, Matt, on the number of millionaires in the US in 1972-76, there was 186,000 individuals were classified as millionaires. That's a net worth of 1 million. By 1981, the number grew to between 350,000 and 500,000, according to IRS study. Today, there's 22.7 million millionaires. We've a lot of billionaires, the 1%. There's a lot of money in the US economy today.
I just want to point out, first off, my first comment is just adjust for inflation. Like, when you throw around the term millionaires, if you go back to your youth and remember when you were young and you're watching these movies about these millionaires and you'd be like, wow, they have a lot of money. Well, if 1 out of every 15 people is a millionaire, that's almost not that much money. It's devalued the term in a lot of ways. And, I'm not trying to say the $1 million is not a lot of money. Obviously it is, but it's not nearly, the butlers and chauffeurs and Rolls Royces that, I used to think of when I was a kid of what millionaires' lives must be like. Second, I pulled up the same stats. It looks like it's accurate, except they use the home equity as one of the calculating parts of the net worth. And I'm not trying to say if you own a house that's worth $1 million, you're not a millionaire, but I think there's a huge difference between having $1 million of investable assets that's liquid outside of your primary home and feeling flush versus having a primary home that, due to policies beyond your control, has now increased in value to north of $1 million. There's a huge difference there. And the data I've been able to find, if you take away home equity, it drops the number of millionaires almost by about half. So a lot of this is just the home inflation we've seen in the last few years. And last point I would make is, if we're adopting the framework that excess spending is what's the cause of inflation, then I think that kind of belies the whole experience we had from 2001 till 2021, where people got really rich and the wealth effect was there, the house appreciation was there, but you never had the inflation because the supply chain was there also to balance the spending. And I think if you go back to the framework of the inflation was much more supply chain based, or supply chain clogged due to the coming out of the pandemic and everyone staying home, and the transition from an experience economy to an experience economy, from a consumption economy, sitting at home and remodeling your house. As the percentage of the wallet changed, you created inflation due to supply chain, not necessarily 100% due to spending. And I agree with Dick the entire time that M2 money printing has been a big factor of it, but that's gone. So even if these 22 million millionaires go out and spend, I feel like the economy can handle it as long as we don't have supply chain issues. So I feel like we're kind of combining three different conversations, and they're not necessarily correlated as directly as you might expect.
There were 2 points that you make that I think are very important. Number one, banks now don't consider millionaires to be wealthy. They consider you have to have 5 million to be in the wealthy class. So you're definitely correct, that simply being a millionaire isn't that indicator of being extremely wealthy. Number two, I'm going to use my father's house. He bought it for $3,000. He sold it for $10,000. It's worth $560,000 today. And that inflation, is the reason why you've seen this huge increase in household wealth. But the bottom line is, at the end of the day, they have more money. We're selling goods in today's prices. And if we want to sell them at today's prices, that money has to be there. The money is there. I believe, as I said many times here, that, it's the growth in money supply which creates the increase in inflation. Obviously, supply chain is a big issue in there also, but I think it's the growth in money supply, and money supply has been shrinking for the last, 18 months. It's down 3.5% year over year. And therefore, I don't think inflation is coming back. But John's question was, how would it come back? And it would come back if money supply increases as a result of increased spending by all of these people who have cash. But I think you're right. Number one, being a millionaire isn't that rich anymore. Number two, a great deal of that money that people think they have is due to the inflated value of their possessions, notably their house, which is their main possession. But number three is, if money supply continues to shrink, you're not going to get inflation coming back.
Matt was talking about the corrosion in the value of the US dollar, or how we've debased it. In 1918, $1 million back in 1918 has as much buying power as $17 million in 2021. So a millionaire just at the end of the First World War and a millionaire today are two distinctly different things. 8.8% of the US adults are millionaires. There's a total of 62.5 million globally, 1/3 of them in the US. So we stand head and shoulders over all our peers across the globe.
Yeah, we are a very wealthy nation. I mean, there is no question about it. Our system works. Our, democracy works. Our capitalism works. Despite all of the fights that we have back and forth, this nation continues to progress economically. It is the best in the world in terms of the method, the functioning of its economic system. It is creating the best population in terms of ability to function, within society of any nation in the world. But the bottom line, the game is counted in dollars. And if the game is counted in dollars, you got a lot of dollars and you spend them, you're creating an inflationary bias. But again, I I don't think inflation is coming back. I think deflation is coming. And I think that, it's due to the fact that the money supply has been, it's down $1.1 trillion, which is about 6% over the last, 18 months. And that has never happened before, ever, in all of the numbers that are published by the United States government.
Of course, it's the middle classes in the US, Dick, in large part drive a lot of the consumption we see at the retail side, the Walmarts, the Targets, the big box stores. And we're getting reports that consumer spending on that side is weakening. So that would also point to inflation, the pace of inflation easing off, as well as what you said about the money supply.
Yeah, and basically, the retail numbers now have been thrown upside down as a result of, Friday, Hyper Monday, or whatever it is. The spending was extremely high on those 2 days, which has always been the case going back historically. So I don't know if this is the beginning of a change in trend, or whether it's just simply the last blowout of the old trend. But we'll find that out over the next couple of weeks, because what we generally find is that the press comes out and says all this money, billions of dollars, was spent on, Black Friday and what is it, Cyber Monday, or what they call it?
Cyber Monday.
Yeah, and there's more billions being spent on Cyber Monday, and they create the impression that retail sales have turned around and that this is going to be a hugely successful holiday spending season. And then you get a week later and a week after that and a week after that, and you find out, no, those are just 2 days of blowout spending, and this is not changing any trends anywhere, which is what I believe is the case.
Are you saying you think retail sales are down?
No, I'm saying that they're not going to go up at anywhere near the rate that was implied by what happened on Friday and Monday.
You think that's just an anomaly?
It has been for the last number of years. For the last number of years, you've always seen, huge numbers on those 2 days. And then, as time passes, you find that, the follow through is not there. In other words, the growth is not at the same level that you get on those 2 days. And again, in-store traffic would suggest that, we're not seeing any change in the basic retail trends that have been established over the last couple of months, or the CEOs of anywhere from Walmart to Target to Home Depot to Lowe's to, Burberry's, what have you, have said they see. I mean, I just think that those 2 days are an anomaly, and you got to forget them and see what's going to happen over the next few weeks.
Nouriel Roubini, Dr. Doom, quite an eccentric character, but he said recently that he thinks there's a high risk of inflation still staying high. And he referenced a lot of threats, ranging from an aging workforce to de-globalization, as well as increasing government spending on areas such as war and climate adaptation. So on the fiscal side, we have challenges as well.
Yeah, well, he's right. If in fact we run huge deficits in order to fight these wars and to fight, pollution control, and for whatever reason that the government wants to spend money, if we're going to run huge deficits, that will force the Federal Reserve to buy those deficits, which will increase the money supply, which would start up inflation. But I think the huge battles that you're having in Congress today, and again, I like to get away from all the political stuff and get down to what is the nub of the argument between the two sides. The nub of the argument is we can't spend all that money. We can't continue to increase the size of the federal deficit. And if we stop doing that, then the Fed doesn't have to do anything. And if the Fed doesn't have to do anything, then money supply will not grow at an unrealistic rate, and we will have, killed inflation.
I mean, going back to your statement where if the Fed is essentially monetizing the debt, that grows the money supply. Wasn't one of the lessons we saw coming out of 2008 when the Fed was, in 2011 and 2012, when the Fed was clearly monetizing the debt, and people like me, and I assume people alongside of me, were thinking this is going to be a massive growth in inflation. It never came. And then during 2020, 2021, where the Fed was monetizing the debt, but the money printing was being doled out to consumers just the government was just mailing checks or depositing money in your account. The wealth effect, or at least the money effect in that instance, where it was a fiscal stimulus, really did correlate with growth and inflation. So is it likely or possible that if they were just monetizing normal course federal spending, that it's not necessarily inflationary?
Yeah, if you got two sources of money creation, in the United States. One is the Fed, the other is the banking system. The Fed tends to be the driver of money creation based upon the federal deficit, but the banks can also be the driver of inflation if they, make a huge amount of loans, increasing the money supply. And after the recession in 2007, 8, 10, the banks were shrinking. The banks were actually, declining in size. And not only were they declining in size, but lending was down dramatically. So that source of money creation was erased. And in my view, that's the reason that you didn't see a high level of inflation, because the banks were not operating in concert with the Fed in terms of increasing money supply. And I think that, we are going to run into that next year anyway, because, I'm convinced that the banks have to shrink, will shrink, and that will be a depressing effect on the economy.
I'm reminded of something you said, Matt, a couple of episodes ago, several episodes ago, about this doom loop and high interest rates. There was a report out of interest rates in the US remain where they are today. Our annual interest expenses will go from a few hundred billion, 680 billion, I think, is our interest payments on the debt, to 1.6 trillion in 6 years, adding roughly another trillion or so to the current $1.7 trillion deficit. In other words, these high rates staying high for so long, it does some damage. Obviously, we see it in the housing market. Maybe that's achieving what the Fed wants to do anyway, to bring inflation down.
It becomes a death loop. I'm sorry. If interest rates by themselves create the situation where the biggest piece of the government's wallet is paying interest, and that it's growing at an accelerating rate, it almost becomes a feedback loop that you can't stop. I think it's crazy. And when you talk about the politics and what they're doing in Washington and what they're fighting over, they're not fighting over anything that will actually change this trend. If you look at where the spending is, it's interest, it's Social Security and Medicaid and Medicare and defense. And those three things are not the areas they're fighting over. They're fighting over how much money to give to Ukraine versus how much money to give to Israel versus maybe changing the asylum laws in the United States. None of those things are going to impact the three biggest components of the budget. And those three things I just mentioned, transfer payments, defense, and interest, already account for more than 100% of federal revenues. So it doesn't matter what they're fighting over unless they're fighting over something that could actually help change the direction of this fiscal cliff we're driving off.
At some point, interest rates have to come down. They just can't stay long for a much longer period. I mean, running into another year or two on these high interest rates, you mentioned the fiscal cliff.
Fiscal cliff. I mean, people saying fiscal cliff have been around since the 1980s. I mean, I was reading the history of the last time Social Security was reformed, and it was in, I think, 1983 with Ronald Reagan, and the Social Security was on the verge of being bankrupt. I mean, they were going to have to cut payments to recipients if they didn't pass this law, and they waited till the very last minute, and they passed it. And it seems, as an observer, that that's what Washington's best at, is waiting until the very last minute, and it takes a crisis. And as long as they can continue printing money and issuing debt, and the dollar holds up in value, and there don't seem to be, on the surface, any consequences for this insanity, it probably will continue. I don't hear anyone in Washington or anyone running for any office in Washington talking about the serious problems. They're talking about the emotional problems, and then the problems that are on the surface, like wars in Europe and wars in the Middle East.
Which brings up a new report that you have out, headlined "Serious Bank Loan Losses Being Ignored by Quite a Few Market Watchers," but you have dug deep into this. You say banking analysis heavily concentrated today on the possible losses that could emanate from the commercial real estate sector. But you look at the highly leveraged loan sector and another side of the market, and you say this is a lot of this, that's what's occurring, is a result of the great inflation that we've had the past few years. How serious could this become, and where is it at?
Well, I think it's going to be extremely serious, and I think that is going to result in loan losses in the banking system being much higher than people are currently estimating. In other words, at the present time, everything you read about loan losses in banking comes down to commercial real estate. And then, when people delve into commercial real estate, it comes down to office buildings. And then when you look at office buildings, it comes down to office buildings in big cities. All right. My belief is that that's not going to be the biggest source of loan losses for the banking industry, because, the bulk of the real estate market in the United States is not going to see, commercial real estate market is not going to see any type of major collapse. And it's even questionable as to whether, these empty office buildings in the big cities are going to sit there empty for a long period, or whether they're going to be, recreated as condominiums. Anyway, what we're saying is, look, if you go back to 1960s and 1970s, everybody talks about the Great Inflation. And that great inflation, was created, by the fact that the United States was fighting a war in Vietnam. And at the same time, it was fighting, or had created, the war on poverty. And as a result of that resulted in significantly faster growth in the money supply of the country. Interest rates were at relatively low levels, nowhere near where they are now or where they were in the Depression. So the net effect is you had a whole bunch of really smart entrepreneurs creating conglomerates. You had a company called Ling Temp Govat, which was created by, a guy who was, an electrician, and who built a company which had, I think, close to $3 billion in assets, which in today's money would be somewhat closer to 30 billion in assets if we took the comparable inflated numbers. Then you had guys like Charlie Bludarn, who created a company called Gulf Plus Western, and you had Harold Janine, who created IT&T. IT&T became the eighth largest company in the United States in 1980, and they all did it by borrowing staggering amounts of money. And they did it because these were the Magnificent Seven of the stock market. These companies were the fast growers. This is where the money went in. And you created these huge conglomerates that were very successful for a limited period of time. What happened was, when, the inflation was killed by Paul Volcker, whatever you want to call it, the Federal Reserve, what have you, interest rates went up dramatically. Money supply was not freely available, and these companies all failed. All right, Ling Temp Govat was in bankruptcy. You had Gulf and Western selling everything it could sell except Paramount Pictures, and today Gulf and Western is Paramount Pictures Plus. And you had, IT&T get rid of just about everything it had. So now it's basically an oil service company, and a company which also services other parts of the manufacturing sector. But it's a tiny company relative to what it was. All right. So now you come fast forward to what's happened over the last few years. You've had the biggest increase in money supply in absolute terms and percentage terms in the post-war period, in any post-war period. So the net effect is all that money went into the same thing it went into back in the 1960s and 1970s. It went into the creation of if you will, disciplinary companies. They are pretty much called private equity firms now, family offices, or, other types of entities, which have, companies that have bought other companies in many, many different industries. And they did it because money was cheap. And, I spoke to a couple of banks, lately about why they were making these loans, because when you look at the cash flowing of the companies that are doing this, and you can't look at most of them because they're private, they're not public. But when you look at it, they're living on borrowed money.
Mm.
So now, the money supply is shrinking, similar to what you saw in 80 and 90, and not only is money supply shrinking, but interest rates are going up. People are talking about how bad it is to have a 7.5% mortgage, which, by the way, is the average mortgage rate in the United States since they started collecting the numbers. It's not a high rate, it's the average rate. Anyway, the point is, these companies, which were borrowing money at SOFR, which is this, like LIBOR, it's at the base interest rate on which you calculate loan prices. Those loans were 3, 4, 5%. Right now, those loans are at 12%, because it's SOFR plus 600 basis points. So, there are two problems that these companies have, similar to what Ling, Bluedorn, and Janine had, which is essentially the money is not available, in sizable amounts any longer. Number one, the cost of that money has simply skyrocketed. The budgets that you had put together at the time that you borrowed this money, got to be thrown out the window, because the debt service payments on what you borrowed are now, double or triple what you had calculated when you borrowed the money in the first place. And therefore, you're going to see collapses, and you're going to see the banks. You're going to see it in the fourth quarter this year. We're not talking about something that's way out in the future. The banks now have been forced by the government to take a look at these loans and to determine whether they want to keep them or not. And the government has already come up with its opinion as to what should be done. The government is increasing the cost of capital to the bank if the bank chooses to continue to keep these loans. In other words, it's not that the government says, hey, I think you should tighten your underwriting. The government is going way beyond that. The government is saying, if you decide you want to continue to lend money to companies that have highly leveraged balance sheets, you're going to have to pay much more in the capital cost of making that loan. So the bankers that I've talked to Wells Fargo, talked to Fifth Third, to Truist. I believe this is strongly being done at PNC. It's being done at Citigroup. These bankers are going loan by loan, and they're saying, we're not going to give you a rollover in that loan, and we are going to charge you much, much more for that loan, so you cover our costs that we've got to pay in capital. That's going to bankrupt a lot of companies. And that's going to be a big loan loss for the banking system. And in my view, that loan loss is going to be substantially greater than anything we're talking about concerning real estate. Because remember, if you take over a real estate loan, you got a building, you got a piece of land, you've got property, you've got something there that is resaleable. If you bankrupt a company in one of these conglomerate positions, you got nothing. Because these loans are made on cash flow, they're not made on, hard assets. So I think it is a huge risk. I think it's something that is not being looked at, because you can't get the numbers, because they're all private companies now. You can't get the numbers the way you could, in the 1980s and 1990s. But I think that people have got to come to grips with this issue, that in the fourth quarter, we will start to see these banks talking about how they've winnowed out their loan portfolios, how they've set aside the proper amount of equity, et cetera, et cetera. But, I noticed that the government has pushed forward the implementation of these rules to the second half of 2024, when they should have gone in effect in January, on January 1st of 2024. And I'm assuming that they pushed out the implementation of these rules because the banks couldn't afford them. The banks couldn't afford what the government is telling them to do. And the banks, by the way, are screaming about it. I mean, they're writing all of these notes to the government saying, you can't do this at all. But the point is, the banks can't afford them. They can't afford these rules. So they've been pushed out in the front. And the way the banks are going to afford them is they got to get rid of these loans. And if they get rid of these loans, there's going to be a lot of pain suffered in the economy, but it's also going to result in a lot of bank loan losses.
I mean, the way you describe it, makes sense to me. I follow the logic. If you're lending against a real estate asset, well, you at least have that asset you can claim. But if you're lending against a conglomerate, which is just cash flows, you're going to have to go in and step in and run that business if they default. And if that business can't afford, to even pay your interest rates, then that business is probably not worth running. But I guess my question is, if you're sitting there at the bank and you're looking at that as your option, is there logic to helping the business and extending a loan that, might not look like it's a great investment, but if you take 100% loss immediately, you might be motivated to actually work out a deal with the borrower to mitigate a loss of 100 cents on the dollar?
Yeah, absolutely. Prior to the passage of the Dodd-Frank Act in 2010, in July of 2010, that's what banks would do. They would not run in and all of a sudden try and bankrupt the companies that had borrowed money from them, because they have to take 100% loss on the loan. So they would do workouts with these companies. Well, Dodd-Frank law says you can't do that. It's not legal any longer. If the company that borrowed money can't make the payment on the money, you can't work out the loan, because you're really forcing the taxpayer through FDIC insurance to take the burden of working out that loan, not you. And therefore, we don't think you should do it. But, assuming that banks still have 100% desire to do what you said, the government's, by increasing the capital cost of the loan, is saying, okay, you want to work with these guys, you want to help them out, we're just going to cost you a heck of a lot of money if you do it. You're going to pay a lot of money if you decide to do it. All right. Because, traditionally what you would do is you would switch over some of this debt to equity. You would, find other, mainly regional banks, smaller banks, and you would create syndicated loans, and you would parcel out a good portion of the loan that was in difficulty. You would lower the interest rates. You had multiple ways of trying to assist these companies, but the government stepped in with Dodd-Frank and said, don't do that. And now the government is saying, if you do that, and we don't catch you, we're going to make you, pay a higher rate, in capital costs for keeping those loans. And I got to tell you, I invite anybody to call any bank that has the ability to talk to the investor relations people or the people in the tops of the banks and ask them this question, which is, are you now going through every loan on your books, trying to determine what the capital cost of that loan is? And if you find that the capital cost is, from your perspective, excessive, are you calling that company and saying, find other ways to borrow the money, we're not going to lend it to you? And I think you'll find, I don't care what bank you call, I don't care if it's JP Morgan down to the Tampa Bay Electronic Bank, that's what they're doing. They're looking at every loan, and they're going through this, mathematical calculation as to how much are they going to get hurt if they get rid of the loan, and how much are they going to hurt if they keep the loan. And the numbers are not coming out in favor, at least of the banks that I'm talking to, of keeping the loan.
You can't quantify it. It's very difficult to get data, but you're hearing this from inside the banks, Dick, obviously.
The way I came across it is by taking a look at companies and taking a look at their balance sheets and the structure of their debt, right? And then taking a look at the cash flow statements. You would be amazed if you subtracted the net increase in debt from the cash flow statements of American companies, how many of them are not generating cash.
Wow.
And you got to generate cash to pay back these loans. So it wasn't a problem when money supply was growing. When the United States, increased the money supply by $7.25 trillion in 3 years, this was not a problem. And when it was keeping interest, I mean, you'll be shocked at how long in 2021 the interest rate on the 90-day Treasury was 1 basis point. Well, it ain't 1 basis point anymore. It's 554. And these loans are based upon a premium to, as I say, SOFR, which think of it as the 90-day Treasury bill in lieu of something better. These loans are based upon 600 basis points above, 500 basis points above. And when you take 500 and you add it to 554, you get close to 11%. When you take 600, you're close to 12%. And when you're taking a look at the return on equity of these companies that have been borrowing money to keep their business going, and you say, okay, now your interest costs are 12% and your debt service costs have just gone through the roof, you're talking about a major problem. And, no one is talking about it. No one is looking at it. And they're going to have to talk about it and look at it in 2024 because these loans are going to start flopping.
I mean, can you take an estimate on it? Are we looking at multiple billions of dollars of losses, hundreds of loan losses?
It'll be billions of dollars of losses.
And these are private equity offices that can conglomerates.
Yes, it is. Yes. Well, I'm sorry. I apologize, Sean. But if it's less than billions, it's spit, right? I mean, JP Morgan has got over $4 trillion in assets. I mean, Fannie Mae has got over $4.5 trillion in assets. As we were saying at the beginning of this conversation, millionaires don't mean anything anymore. But the point is that it has to be in the multiple billions, and it will be in the multiple billions because that's the size of these loans.
And just finally on your note, it is more than likely that these losses will represent a greater risk to banking than consumer real estate. And there's been a lot of fear mongering about the commercial real estate sector. So we're looking at something potentially pretty awful.
Commercial real estate has always been a good investment in the United States. And I think it's a good investment in at the present time also, because the population may not be growing very rapidly, but the population is growing. The population, as it grows, is going to need these buildings to function out of. These businesses that are growing need these buildings to function out of. I don't think that you should worry about commercial real estate. I really don't think so. I mean, there'll be some losses, absolutely, definitely, without any question, because of the change in interest rates. But the fact of the matter is, you still have something there that's something that people are going to want to use because it has value to them to do what it is that they want to do. They want to live there. They want to run their business from there. They want to have recreational activities there. Real estate has value, and it's not going to be destroyed. Conglomerates, private equity firms that have purchased other firms which are, smaller in nature and don't have, a large amount of hard assets. That's where the problem is. That's where the risk is. And that's where people should be focusing. They don't focus on it because they can't tell how much money is wrapped up there.
It brings up something really interesting here because you've spoken, Dick, about a shake-up in the banking sector with the new rules. They've been delayed into next year, you're saying. So here's my thought, because you were asked this by a reporter recently. Do you think it was a mistake for the government to let commercial banks dive into investment banking in the 1990s? And a bit of context is really important, because we had the Financial Services Modernization Act of 1999 signed by Clinton, which reversed everything we had right after the Great Depression when they separated commercial and investment banking. And there was this theory that having both of them together led to the crash, just those reckless money borrowing and so on. So I'm wondering if what we're seeing now is a kind of a return to the old order on one level, the separation of investment banking and commercial, because these rules are making it more difficult for the bank to get into this kind of higher risk lending.
Yeah, well, I think that it was absolutely critically necessary to put investment banking back together with commercial banking. Every nation in the world has a banking system, and there's not one of those nations that I'm aware of that these two sectors are separate. And the reason why they're not separate is because of the change. Well, they're not separate because of the need to move funds more freely to areas where they're needed. But the point is, with the changes in banking, which have been beyond belief over the last 50 years, you simply had to put these two businesses back together. Now, I understand that in the 1920s, there were all of these companies that were, messed up, in both investment banking and commercial banking. And there were, conglomerates that were called trusts at that point in time. There's always a different name for it, but it's always the same type of business. These trusts, took advantage of these things. And in the 1930s, these trusts became, a major attack by the legislators, namely, this guy Carter Glass from Virginia. So basically what they did was they decided that the solution was, we can't clean up these companies, so we'll just force them to operate in a different mode. We'll pass what became the Glass-Steagall Act, and this Glass-Steagall Act separated them. But when you got to the 1990s, you just could not keep them separate if you wanted American banking to survive, number one, and if you wanted it to be able to compete in the world market. They had to have both capabilities. So I think the law was absolutely necessary.
What's occurring now, Dick? The new rules coming out, the restrictions on the bank. Are they going to start clamping down in other areas? Sort of a return to the separation of commercial banking and investment banking if the regulators say the risks are too high?
Nobody's thinking of doing that. No one is even remotely considering doing that, because it's like saying, okay, let's take all technology out of banking, because technology is, depersonalizes the bank. You're not going to take technology out of banking. Nobody's remotely thinking of separating investment banks and commercial banks. What they're thinking of is how to control the risk within the institution by taking a look at the way they lend their money, the way they put their money available. The whole fear on the part of the government is you can't use FDIC insurance to support trading. You can't use FDIC insurance to support, if you will, investment banking. You can't use FDIC insurance to support, highly leveraged loans. But we're not telling you to stop doing it. We're saying if you want to continue to do it, you're going to pay a lot of money. You're going to have to come up with a lot of capital to do it. Because if we're going to allow you to have FDIC insurance, you're going to have to pay a lot of money to get that access if you want to do these things that you think are so important to your business. But no one is thinking of separating, commercial. Well, I shouldn't say no one. Elizabeth Warren put a bill into Congress, which was co-signed when he was alive by John McCain. And the bill said, bring back Glass-Steagall and separate investment banking from, commercial banking. And now you got John McCain, highly respected Republican, Elizabeth Warren, highly respected, I would assume, by the liberal faction. The bill didn't make it out of committee.
Yeah,
it didn't even make it out of committee. Never went to the floors of the Senate because it was, it's just, you can't do this. It's like saying, okay, let's go back and live in caves.
Well, we know Elizabeth Warren hates those evil bankers.
I'm sorry. I think aside from the fact that it's Elizabeth Warren, I think someone like her, some of these people that are more known for being bomb throwers than for being serious people, kind of hurt their cause because of her reputation. But the idea that the reversal of Glass-Steagall was a no-brainer and it turned out to be really successful, I think is extremely controversial. The problem I feel we have is we don't have serious people in Congress looking at things like this anymore. And Elizabeth Warren isn't taken seriously because of her extracurricular activities. And it would be great if we did have, someone who could articulate her position without being castigated because of her, outside reputation of being, toxic.
Yeah, well, she actually is one of the smartest people that I've ever heard in Congress, in the sense that she does her homework when you have to listen to a lot of congressional hearings, and if you're an analyst, and you get to see who is just bombast and who has done the work and really knows what they're talking about. And Elizabeth Warren has done her work, but she takes these wacky positions. I mean, she does the work, and then the conclusions that springs out of that work tend to not be rational. And I think that's what causes, I'm not aware of any bill that she's ever worked on of stature that got passed, because it's not because she doesn't know what she's talking about. She does. It's because her solutions are not related to the work that she's done. I mean, she's on this big kick now to create real problems with Zelle within the banking industry. But why? I mean, Zelle is working. The amount of fraud in Zelle is infinitesimal relative to the amount of money that is being, passed. I mean, why take on Zelle? I mean, why take on Glass-Steagall? Why take on these Pyrrhic, if you will, fights, if I can call it that? Why not just take what you've done and come up with some rational, recommendations? Now, I have to go back. Before she was a senator, she's the one who came up with the Consumer Financial, whatever it's called, commission. That was her idea, and that did get passed. But that's the only thing I'm aware of that she ever put into effect.
What's your take on the big banks, Dick? Because another question you were asked by a reporter recently was, do you think we'll ever get to a place where the biggest banks in America are not too big to fail? It would strike me that there's a rump core in Congress who would want the big banks to fail, although they may not be that stupid. I mean, what's your thoughts?
Well, number one, it's impossible. All right. We will never get to a position where the biggest banks in any country, or what you're talking about is the entities that run the financial system, country by country, will never get to the point where they are not going to fail. And if they fail, we're never going to get to the point where that will not impact the economy.
On the global stage, a couple of headlines. They're sort of random, but everything's all connected on the geopolitical front, and we have to watch it. Moscow holds the advantage on the military, political, and economic fronts as Russia's war against Ukraine approaches its third year. Analysts still say Putin is a long way from conquering the Ukraine region Russia has claimed. Meanwhile, Elon Musk was in Israel touring the scenes of the horrible Hamas attacks and condemning the attacks. But he made a really interesting point. He said Gaza must be made more prosperous and he would love to help. So, when you hear comments like that, there's grounds for hope, but ideology and history and politics always gets in the way of progress, it seems.
Yeah, well, I think, that's Matt's point that he continually makes, right? Which is that we don't have the people in Washington who can solve the problems because they're too involved with the politics and the interpersonal fights, et cetera. And that's true all over the world, right? I mean, if you think of Hamas, and you think about what if all that money that went into building those tunnels and getting those rockets were invested in the creation of businesses, and those businesses would very prosperous today, functioning, selling products all through the Arab world, all through the Middle East, maybe around the globe. Would Hamas be throwing bombs at Israel? They wouldn't do it. You wouldn't have that war. But they can't think that way. They can't think that, if we create exactly what you said, Elon Musk says that is required, if they would create a very prosperous nation, in Palestine, they wouldn't have the need to want to go out and kill, Israelis and vice versa. I mean, and yet it's the hatreds, all the things that you mentioned that get in the way of rational thinking, and you get war. As far as Ukraine is concerned, it looks like that's a stalemate such as we saw in Afghanistan, such as we saw ultimately in Vietnam, such as we saw, in Iraq. If Russia wants to sit there and continue to spend all this money to maintain this stalemate, good luck to them. But I don't see that. To me, this war is basically over in terms of one side conquering the other, and it's now just wasting men, material.
Yeah, it's a horrible state of affairs, horrible. Yeah. And we have an influenza outbreak in China. I wonder, there's no lockdowns the way we had after COVID, but it's getting a lot of attention. and some neighboring countries are also taking defensive measures so that it doesn't spread to their native populations. And China, by the way, according to a news report on the South China Morning Post, is reportedly building a nuclear power plant in Argentina as it looks to engage in Latin America further. But we'll see where that goes in Argentina, because we've a new conservative-leaning president. He might have a whole different attitude to China.
Look, any country where China offers money, they've taken the money. All right, and there are supposedly, if the Kiel Institute is correct, there are supposedly 150 countries that have taken the money. All right, and the problem that China now has is getting them to repay the money, and taking over pieces of their land is not the solution for China, because China has got a real estate problem of its own. So this is a highly complex issue. I mean, I'm reading a book about the rare metals problem, and apparently China controls most of the production coming out of the Congo of cobalt, which is the most important metal in terms of all of your Apple phone and all of these other technological advances. So China is everywhere. Their problem is that they got to get their economy working again if they want to make sure that they can continue this pursuit of developing dominant positions nation by nation.
Javier Milei, new president, talking about dollarization of the local currency. So that'll be kind of interesting to watch. We're almost out of time, Dick. We're going to have the inflation numbers coming out later in the week, and we can look at that and interest rates.
Well, I mean, I don't think that we're going to get any surprises. I think that if the CPI and the PPI numbers are accurate, if the commodity numbers are accurate, then it's unlikely that we're going to get any major surprise in terms of the inflation numbers. I think they should be moderately positive.
Dick and Matt, we are finally out of time. A great conversation. We'll be back next week for more on the markets, interest rates, banks, the economy, and global events. And until then, until episode 98, take care.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.